Welcome, my friend, to this Forex Trader Pro tutorial on how to have failed trades that make money. Kind of a strange statement, but yes, you can have failed trades that make money. In fact, I would propose that you better have them. So here is what I mean. So the first thing that you want to really master in trading is not what's the best moving average, what's the best indicator, what's the best time interval, what's the best market, what are the best support resistance levels, all that kind of stuff. These are the kinds of questions that I receive most frequently. And they're fine, they're good questions, but the more important question that I hardly ever am asked is, Barry, how do you manage risk and what type of money management methodology do you employ? Those are the two most important things in all of trading, whether you're trading Forex or stocks or the E-minis, futures, commodities, options, whatever it is. Money management and risk management, that's what professional traders live and die by. More so than indicators or candlesticks or moving averages or any of that other stuff. So I'm not sharing with you any particular trade technique today. The point is, whatever trade technique you're applying this to, a trend trade, triangle trade, wedges, any type of trade that you have a moving average crossover, this type of approach is required. Very important. So let's go down here and we'll use our Fibonacci extensions. We'll go from there to there. Okay. Oh, actually what I want to do is go from there to there. Yeah. Yes. Okay. And then we'll bring it back down here. Okay, so what this is showing is the market came down from that high. And let's say that we want to buy this low. Okie dokie, very good, cool. Now, we're going to go along and we're going to hope that this trend continues. That's our plan. That's our ideal world. That's why we're taking the trade, and we would consider it a successful trade if the market broke this high here. Right? We want it to make a higher high. Keep going. We want that 3-to-1 reward to risk ratio. And the reason I do these Fibonacci extensions on here is because you can see that will be 100% reward. In other words, not really 100% reward. That's basically a 1-to-1 reward to risk ratio. So if you're taking the trade down here, it's actually a little worse depending on exactly where you get in. But if you got in at the very bottom, which would be best case scenario and pretty much impossible, okay, so this will be even worse than we think. And we get up here and we're looking for it to break that high. Obviously, that's why we are looking to make big profits. However, what happens? It does not break that high. In fact, it hits that high. This is now resistance. You got the same resistance over here, by the way. And you got resistance there. So this is the third time it's coming to that resistance. And for my actual students, this is the TopDogTrading rule of 3. So you know that this would be a great opportunity to take a short if we get the signal. But since we're talking about a long position right now, we have about a 1-to-1 reward to risk ratio. So those who say, well, I'm not going to take a 1-to-1 reward risk ratio because I need my winners bigger than my losses. And I would say to you this: risk reward ratio and win-loss ratio are inversely correlated. This is why there are a lot of people who make money just scalping the market. They're taking quick little moves, just like a half cycle like that. And they might just have a 1-to-1 reward to risk ratio on all their trades, but they still make money. Why? Because it's easier to determine the future of the market very short term. Again, longer the time goes on, less likely it is to continue because of all these different things that can happen between now and then that changes market sentiment. So, because of that, getting a good reward to risk ratio consistently more than half the time is nearly impossible. Just not really the statistics of how it works. And so your win-loss ratio will be lower if you insist on getting a great reward to risk ratio. Those are going to be inversed. If you just take low scalp trades, then your win-loss ratio will be high, but reward to risk ratio will be low. So what I do is I like to do a combination of the two. And I peel positions off. Now, you'll hear of people who add to the position as the market goes on. I don't do that. The reason that I don't do that is because they're doing that technique hoping, again, for a big reward to risk ratio. That is the exception to the rule, and therefore I'd rather play the rule. So I go all in at the beginning, and then I peel money off because, again, I know that first impulse move, that's my strongest probability. So that's where I want all my money. So what I will do is I will go ahead and lock in some profits up here. Not my whole position, but part of my position. So took a few lots there long, and yeah, it's not a lot of money. But here's what it does. It does two things. Number one, it does put some green in your wallet or your purse. So right now you got money, you've made money, you have, in that sense, a profitable trade. You've made some money. Here's the other thing. It reduces your risk. Why does it reduce your risk? Let's say they're trading, 4 lots, and you lock in profits on just 2 lots there. Well, now your risk on the trade is only 2 lots, where at the beginning of your trade it was 4 lots. So you've now cut your risk in half, but wait, you cut it by more than half because you've already made some money. You got some profits up here. So you lock in some profits here. If it comes all the way back down here and breaks this low, it's on half the number of lots, but you're not losing half as much because you've already made some money here. So now maybe you only lose, about 1/8 of your original position. Not bad. This is how we keep our losses small. And then we'll let our winners run. We let our winners run. That's why we're not taking off everything here, because I personally don't want to just take little scalp trades like that too often. I have a couple setups that work that way. But the majority of the time, I'm looking for a combination, a good mix of definitely high win-loss ratio. Now, trend traders, professional trend traders, are notorious for having a worse than 50-50 win-loss ratio. But they're still successful because, again, a trend is a long-term move. They're looking for that great reward to risk ratio. They do get it, but less than half the time. But because, again, they're very good at money management, they still make money in the end. Scalpers have a huge win-loss ratio, but a very, very small risk-reward ratio. So there's many different ways to play the trading business, right? There's no one right way. So I do a combination because I want the high win-loss ratio, but I also want the potential to get the big reward, even if it's on smaller size. That's okay, because that's, again, the exception, so I'll take it on the smaller size. And then, of course, what I would do here is I wouldn't even wait for it to come back down here for my stop. I mean, that seriously would be kind of ridiculous. But some people would. They would put their stop down here, and that is where my initial stop would be. That's where my initial protective stop would be. Where I would change it is when, again, we got the top dog trade rule of 3. So 1, 2, 3. In other words, comes up to the same high. That's basically kind of like a triple top. You can think of it that way in this particular situation. But then not only do we get that, then we also get an engulfing candlestick. And look at this. The engulfing candlestick, here's a little extra tip for you, engulfs 3 bars before it. So most people talk about engulfing candlesticks being a 2-bar pattern. It is. That's true. But this particular one is a 4-bar pattern. I consider a 4-bar engulfing pattern stronger than just 2. And that's a very bearish signal. So the reason that I would then take that short, or at least, the very least, I would get out below here, or get out here, instead of getting out here. So now, if I got in here, then I'm pretty much getting out where I got in. And I made a little money up here. And guess what that is? That is a failed trade that made money. A lot of money? Nope. But it's better than a loss, right? So that's how we do it. Now, this, again, is a great reversal trade. That's why I would actually get out here. I would stop and reverse into it, personally, is what I would do. Top dog trading rule of 3, triple bar engulfing pattern. That's just a great move. And now, again, my initial risk would be this box. And our reward, well, now we finally get a really nice reward to risk ratio trade. Share this with other people. That's the best way that you can pay this value forward, is to actually literally pay the instruction forward to some other good people. It's always a good thing to do. It gives you good karma. Also, feel free to leave a comment and thumbs up. Love your comments, by the way. And finally, I do have a very, very special trade that I want to show you called the rubber band trade. I'll give it to you absolutely free. It's a complete trade strategy. You can use this on Forex, stocks, E-minis, whatever. It's very simple. And this one is a scalp trade, by the way. So it has a super high win-loss ratio. This just brings in nice income consistently. And I've got a little mini course that teaches you that. So we'll show you exactly where to get in, place your stops, and take your exits. Much more detailed than I can do on these YouTube videos. A little longer, obviously. So if you'd like that free course, just click on the link in the top right corner of this video, and I will email that out to you immediately.